sit here and
looking at you. Oh my goodness.
I know.
I'm going to share our screen so that they can see it directly on the screen instead of seeing the
Yes.
engraving.
Did you get that thing figured out with that? You accidentally called out.
No, I mean, I just responded to them and that was it.
But did you
You're
read that?
Yeah.
Oh, I love it.
so to go, you just hit
The arrow.
it's arrows. Now can I go back as well? Right?
Yes.
Perfect. In case I get trigger happy here.
I mean, you know, I just ignored
Okay.
the one favorite here.
All right.
Yeah, go ahead and run that.
Okay.
I have a lot of-
I'm not gonna get another little high
All right.
No.
We're gonna get started here. Now, is the speaker, can everybody like, everyone online? Okay. All right, we're gonna get started here with this unbelievably exciting topic of credit scores and understanding credit scores. So, just as a little introduction, my name is Ryan Doehrmann. Recently, I used to be our sales manager, and I covered our markets over east, Cedar Falls, Waterloo, Iowa City, Cedar Rapids, and Grinnell. And then the person that was our head of our mortgage department, Amy Henderson, covered over here and our Quad City, which is our two newer markets. Amy has since moved up into a different position. I slid into head of our mortgage. I'm still going to supervise our lenders over in the Iowa City areas and Quad Cities. And then Jody Booth here, who's in the back, super excited to have her. She's been a sales manager, been in the mortgage industry for what, 20 some years, forever. She came to us from Hills Bank, which is a super big community bank over in the Iowa City, Cedar Rapids area. She's been their sales manager for the last 5-6 years. So I competed directly with her. So it's kind of awkward when I asked her to join us, but she made the leap, and she's going to be really covering this market. You should see more of a presence of us over here. Amy, again, she had such a ton of responsibilities, but now we have dedicated sales manager over here. So we should be stopping into offices more, going out for coffee, lunch more often, just being involved. To me, this is by far our biggest growth area, especially where our branch expansion is going to be focused over in this area. So thanks for having us. Just a little bit of overview. I will try to go, my promise is I'll try to go quick, but this is open-ended. This is just me talking the whole time. I've done this PowerPoint numerous times. I got to have questions, okay? So if you see something, I don't know if the people online can chat too and ask questions. Do my best to answer them, but my gosh, if it's me talking for 40 minutes on credit scores, we're going to be asleep here. So it's really good. This is good for you guys for your personal credit and asking questions, but also too for your clients, kind of what they go through, or if you know they had credit issues, maybe you can give them tips throughout the process too, if they're trying to get pre-approved and they're running into some issues. So we'll kind of go to the scoring models, what actions hurt your score, how do you improve it, and then at the end, how do you get a credit report, how can you monitor it? I've got a free service that probably a lot of you already know about, but there's some surprising that have not heard about it, so we'll go over that. So what is a credit score? So it's basically just us. It's a number that tells us their people's ability to are they going to pay us back? Okay, you know, way back when, 30 years ago, a lot of it was a handshake, but those days are over. So how likely is it that someone's going to pay us back? And really, we'll get some time. How big is the credit score influence? It's big because it has to do with whether we're going to lend or what rate somebody gets. So missing a small credit card payment, you know, a month before they're closing really hurts them because it drops them about 60%, or excuse me, 60 points, and adds probably 0.5% onto their interest rate at times. So it's extremely important when someone's going and trying to get pre-approved or buying a home, even during the process. Because one of the questions we'll get is, do you re-poll a score? We don't, but we do re-poll their balances. And so if their balances have gone up, and we'll talk about this later, but if they increase their debt during when they're doing the home buying purchase, that can affect an approval. So just some other names. The three main credit bureaus are Equifax, Experian, and TransUnion. All mortgage lenders pull all three of those. It's called the tri-merge credit report. Sometimes you'll hear it as FICO, Beacon, the last one there, Empirica, you don't hear very often, but the three main ones are Equifax, Experian, and TransUnion. Those are the three ones you have to go through. If there's issues on your credit report, you got to reach out to all three of them. Now, how we score it is we bring back all three, we throw out the high, you throw out the low, and you use the middle score. Okay? When you go buy a car or go take out a loan or a credit card, usually places just pull Equifax. Okay? You just pull one score, but all mortgage lenders pull what they call a tri-merge and throw out the high and low and use the middle score. Now, when there are two borrowers on a loan, you always use the lower of the two. So sometimes when you hear us, let's say you have a couple purchasing a home, but maybe we only have one borrower on the loan, and maybe at a closing, you might wonder why there's only one person signing the loan docs. It may be because we had to pull one of the borrowers off because they still qualified with only one borrower, but if we had the other one on there, it affected their interest rate or their approval. So sometimes that is a reason why we only have one person on the loan. It has to do with their credit scores. So pretty self-explanatory on what it ignores. The first bullet point, gosh, I hope it would never come into play there, but age it does not know your salary or your income. There have been some that have asked that question. It knows no history of any of that, or if you're a job hopper or you're unemployed at the time, it doesn't look at that. Doesn't know what interest rates that you're being charged, certain type of inquiries, promotional, like when someone sends you a credit card offer, people have thought, well, you're going to hurt my credit score, or a lot of employment now, especially us, and when we're lending money, when people come to work for us, we pull a credit report. That does not affect their credit score at all. So what does it consider? And we'll go through each one of these bullet points and how it affects their actual score. But first and foremost, payment history. That's the biggest portion of the pie. I mean, how well do you pay your bills? But it also looks on the amounts that you owe on certain accounts, especially on credit cards. The length of your history comes into play, and then if you've pulled out new credit recently. And that's why we'll tell people, and it's on our website, and I'm going to do this website demonstration sometimes at one of your Tuesday meetings because it goes through this, but especially when they're in the process of buying a new home or they already have an offer, never ever apply for anything or open new debt, because that can drop the score or increase your debt, and then your debt to income ratio can be thrown off on that. And then the types of credit used, a lot of people don't know, but you've got home loans, installment loans, like your car loans, where there's a set payment, a set time frame to have it paid off. But then there's also what they call finance company accounts, payday loan type of loans. The credit bureaus can see that because most people do not go to those type of places to borrow money. So if you go to there, it looks at that and it triggers it. You have some sort of issue going on if you go to a payday loan store or a place that charges 30% for stuff, and a credit bureau can see that.
So length of credit history, what is that?
So that would be like if you're young, so someone that's had credit for 30 years and has made perfect payments and does not have a lot of debt would have a better credit score than somebody that's like 21 years old. So I'll just jump into that one on the length. I go and teach a class. I'm from Williamsburg, guys, over by Iowa City, and I'll go to that high school every year and talk about credit and how they can build it. And I always give them the tip: when you get into college, go to whatever place your mom and dad banks at, and have them take out like a $500 limit credit card. Mom or dad is on there, but then have you be the co-borrower, so you build credit when you're in college. So you have 4 years of credit built up when you're done with college and maybe you want to go buy a home. Because a lot of times we'll get people that come in straight out of college and they have 0 credit score, which is, well, I've never had to borrow anything. It's still looked at as a negative. But if you can build your history younger and have mom or dad help it, so they see the statements and all that, and you don't have a big limit on there. But the length of the history does come into play. But your payment history is 35% of your total credit score. The amounts that you owe is the next, the length of your credit history, and then if you have any new credit or the types of credit that you have in use. But you can see by far the 2 biggest pieces and chunks is the payment history and how much you actually owe, which it should.
I have a question.
Yeah, you bet.
Because my husband and I have a cashback credit card.
Yeah.
So we charge everything.
Good question.
Everything.
Mhm.
And then we pay it off
Mhm.
whenever we get a bill. So I know that it's never hurt us in purchasing a home, but could it hurt somebody if?
That's an awesome question. The credit bureau switched recently, or at least the credit company that we go through for our credit reports. It can now look at your balance history for those people that charge everything up, because what will happen is when you do that, your billing cycle might not be end until like the 15th. So most companies report their debts to the bureau at the end of the month. So you might have $5,000 on there because you're charging everything, and then it gets reported to the credit bureau, $5,000 on it. But the bureaus now can see if you're somebody that pays off a credit card every month, then you're fine. But if you've known to carry that $5,000 to $10,000 balance every single month and just make minimum payments, it's not bad, but it does have an adverse effect. It'll hurt you more than if someone that just pays it off every month. The bureaus can see that. They can see your history if you pay it down. Now with that, the amounts that you owe, based on you, I would hope that your credit card limit is high. Because
Keep making higher and higher.
yeah, I know. They love you. But because on credit cards, if you're over 30% of what the total limit is, your score is dropped a little bit. So it's better to have a few credit cards with balances spread out than have one credit card with a 10,000 limit and owe like $5,000 on it. So it looks at your proportion of your balance compared to your credit limit. All right, so it's typically that equation is 30% or less of your credit limit. So I told people before, if you got only like $5,000 in your credit card, just call them and they'll increase it for you if you've been a good customer, just so you don't ever get close to that. And if you go over a month or two, it's not the end of the world, right? It can drop you. So payment history, again, the biggest piece of that pie, it just looks on all of your accounts, credit cards, retail accounts, and how well you paid it. They only report if you miss your payment, but you're 10 days late, you're going to get socked with a late fee. That does not hurt your credit score. They only report if you're 30, 60, and 90 days past due. As you go down that chain, it's more severe, right? So you have a 30-day or a 60 and multiple, that's going to hurt you more than a 30. They'll look at any public records that are on there. If you had a bankruptcy in the last 7 to 10 years, judgments, lawsuits, any liens, collection items. The one thing that they have changed recently is medical collections do not hurt you like they used to, because we would have in Iowa City, at University of Iowa, in Mercy, were notorious. If you missed a payment, even for like $15, and you were like 20 days, they would send it to collections and not even tell you. So we would always pull up a credit report and someone would have a couple $20 collection payments and their scores would be dropped. But those do not affect as hard or as much anymore. But bounce checks that go to collection, those obviously do. Okay. How long have they been delinquent? So the most notorious that I can see that where this comes into play is on student loans. And you might get some new first-time home buyers that have, every kid nowadays pretty much has student loans. But when they move, sometimes they don't know the severity of when you're out of school and they don't know where you're at. and they're trying to send you the bills and you just ignore them, they ding you bad. So I have seen multiple young people with like 90 days late on their student loans. And so then they come to buy a home and their credit scores are 600 because their history is not that long. And the only history they have has been late. So we'll try to counsel the first timers, especially if they just got out of school, like, hey, track down your student loans and know what's going on, because those are the ones that we see that have the biggest past dues. The amount of the past dues, so something that's got $20 past due is not going to hurt you as much. Something as, an entire account, like $2,000 credit card sitting in a collection, those really affect your credit score. And then the time that it's gone. So if you missed a credit card payment 2 years ago, time, just like anything, time heals. So what we've seen a few times is if someone misses Von Maur, gosh, I used to have to counsel, no offense, I had to counsel the ladies because they all have Von Maur cards because they're 0%, but I had a couple of them one time miss the minimum payment on it, and it dropped them like 80. They're like, oh my God, I've never missed a payment on it, but I just did, so it dropped them 80 points. But if that late had been 2 years ago, it doesn't hurt as much. So really on those retail department store cards where you maybe don't use them as much, sometimes you forget about them. We've had that in the past really kind of hurt some people. And then the number of past due items, if you have one or multiple, those can really hurt you. The amounts that you owe, it's just as plain and simple, just looking at how much you have. The biggest, where this comes into play is on credit cards, or the amount. On installment loans where there's a set payment, like I said earlier, a set amount and a set payment to pay it off in 5 years, that's not because, when you get a car loan, it's up there. But if you have, 10, 15,000 on a credit card, that's gonna, and you carry that each month, the credit bureaus ding you on that because you're just kind of, living a little bit dangerously on that. Specific types of accounts. So credit cards, and like I mentioned earlier, finance company accounts where interest rates are all over 20%, they can tell that. And if you carry a balance on that, it's looked at as negative. Not the end of the world, but as long as you're making the payments on it, but it will drop you a little bit. Lack of a specific type of balance. So for example, when I go talk to that class, I always say, take out a good mix. A good mix would be a mortgage loan, an auto loan, and maybe 1 to 2 credit cards. Don't have 5 credit cards or 6 credit cards, all with balances on them. It looks at installment debt, a good mix of installment and credit card debt. All right, so if you had 5 accounts and they're all credit cards, you will have a lower credit score than somebody that has 5 accounts but has a car loan mixed in there and maybe 1 or 2 credit cards. And I've had some where all they have is just a credit card, and that's all they've ever had, and their score is still decent, or pretty good, but it wouldn't have been, it would have been better if they had some point had a car loan that they had paid back at some point. And I get it, like, why take out a debt if you don't need it? But there are some times where we have tried to help some people, especially when they're younger, when they have had nothing. We'll give them like $1,000 personal loan instead of a credit card. We'll put the money into a savings account and then set up an automatic payment that goes to pay that every month to help build their credit, because an installment debt does help. And then the number of accounts with balances. The most I've ever seen, I was a lender in Chicago way back when. I had somebody have 40 accounts, 35 of them were credit cards, and they never missed a payment on them. They had 2 mortgages, 35 credit cards. It was a doctor. It was the most unbelievable thing I've ever seen in my life. And the doctor's wife managed it all and never missed a payment. Yeah.
Well, that brings up like all the different retail stores that you can get credit cards at.
Mm-hmm.
How do those ever fall off?
So if you close them, those will pop
If you
off.
never officially close them.
Well, no, it'll say, now they will sometimes close it like, just due to inactivity, they'll close it on you.
Okay.
But it looks better on a credit bureau if you close it than if than the company closed it.
Okay.
Just FYI. So if you have a bunch of, I see that with young people too. They have American Eagle, Victoria's Secret, Gap, all these departments. Those rates are 20%. Why not just-
Extra 10%.
You do the first time.
Open it.
Yeah. Yes.
I'd buy a pair of socks.
Yeah. So I used to tell them, just close those. You don't need them. As long as you have your main credit card, that's fixed at 9% or whatever it is. You don't need all those department store cards. I don't argue with Bonmar anymore just because it's 0%. It's a great credit card to get first, but the rest of them you don't need. We talked about the proportion of your credit cards, the proportion of the debt compared to the limit. That's big. All right. And then installment debt, as you pay it down, as years go by, and your car loans, as you pay it down, that's giving you, even though it's debt, it's a positive influence on your credit score.
If you pay off like a home, house, or a mortgage, is that a negative or a positive?
No, positive. Yeah. Now, it helps your credit score if you have a perfect mortgage payment on there, but I would rather pay my mortgage off than have one on there. But no, that does not affect you. So length of history, we kind of covered this earlier, but it's all it's looking at is the time that you've had it. So if the credit bureau can see though, if you're younger, they get that, but if you're 35 years old and never had credit, it takes you a little bit to get that going. And we don't see that very often these days. I mean, most people have to have some sort of debt out there. It looks at the time that since the account has been opened. So if you have gone out and opened like a few credit cards all within a short time frame, the bureau is looking at that saying, why is this person taking out multiple credit cards? There's some sort of situation going on where they need to borrow something. And so that can drop you. I'm not saying a ton. And you're kind of hearing me talk. There's no exact science between these credit scores. So I can't tell you, hey, you do this, it's going to drop you exactly 50 points, right? That they don't give you that. Just over time and experience, you can kind of tell what's going on, but it does look, that's why I said that earlier. When someone is in the home buying process, freeze, don't do anything. Don't go, what's the main thing that they go and buy though? Furniture. Just wait, go pick it out and don't. We had an instance, guys, this was in this market. We had this in this market last month. We can do some stuff on our in-house stuff that maybe others can't. So high net worth borrower buying a big home, had some debt, or they wanted to buy before they sold their other home. So the debt to income ratio was up there. Well, it was already pushing kind of the limit. They went and bought $20,000 worth of furniture at Homemakers, and my wife loves driving all this way to come that every other month. Homemakers, but it hadn't been delivered yet. So they're, my lender and then the home buyer, I can see how they would think that. Well, I don't have it yet. The account hasn't started. Doesn't matter. You applied for it. We can tell them the credit bureau that you've applied for it. We know that $20,000 is going to hit your account in a month. We got to hit you with a payment. It made that person not qualify. We had to do some things on this to get it to work, but you'll run into a situation like that. It was the craziest thing, 20 grand on a furniture. You just would have waited a week to do it. So when I do that website presentation sometimes in the education center, there is a tab on there that it would be awesome if you guys, I'll show you how to get to there, but you can go and copy and paste that verbiage onto your own letterhead and give it to your clients too, if you hand them packets when you first meet with them. It just is some reminders. Here's the do's and don'ts. And that's the biggest thing, is someone will go and take out stuff during the home buying process. So, and then new credit, folks. If you had a bunch of everybody's got to open an account every once in a while, but if you've had a ton of new credit opened up in a short period of time, they look at that. All right. The last bullet there, I do want to talk about that. So if you've had some past issues, either a bankruptcy or some payment problems, You have to rebuild it, some reestablishment of positive credit history in order to get back there, but it does. Time heals. It's the hardest conversation to have when you pull someone's credit report and they either had a bankruptcy, within the last year. You just have to tell them to wait and just, you have to take out some other debt. If they wiped all their debt out, they have to reopen some to start using again. Sometimes it's hard to get that. But if you missed a payment, like on a Von Mauer card for $20 or whatever it is, you have to go by for a few months to a year to kind of get you back to where you are. Right? It's easy to mess it up, but then it's super hard to kind of build it back to where it is. That's kind of the unfair part. And then types of credit use. So the number of, the presence of various types of accounts, multiple credit cards, retail store accounts, like we were just talking about, installment loans, mortgages, but the biggest one on there is the consumer finance accounts. So when you go, furniture store cards, anything that you have to go through, like there used to be Wells Fargo Financial and Citi Financial, those kind of companies are kind of gone now, but those were notorious. If you had those, they would be 20 to 30% accounts. So you don't see them a ton anymore, but like I've mentioned a few times, it's the credit bureaus know those and have flagged those type of accounts. So what hurts? Missing payments, regardless of the amount, takes a full 2 years to kind of restore with one $15 missed retail store account. It's just crazy, and probably drops you, just on my experience, about 50 to 60 points. So someone that was a 740 credit score that qualified for a 3.75% interest rate, you miss a Von Mauer card payment for $60, now it takes you to $680, and your interest rate went from 3.75 to 4.25. And now your payment, if it's on a $400,000 home, that's a big, even on 150, that's big. It adds up over time just because you forgot to make the payment. And cards at the maximum credit limits. But again, if you're one that pays off every month and you put everything on there for the rewards, the bureaus can see that history of making the full payments. But I would just encourage you to make sure your credit limit is high enough, so when it does report to the bureau, that you're under the 30% of your total limit. Okay, can't stress that one enough. And that one, a lot of people don't even know about that rule that's out there. Closing credit cards. This one comes up a lot too. I haven't heard if I close accounts out that drops my credit score. Yes and no. So if credit cards, they look at your total balances to your total credit limits. So it's your proportion of all of those balances to your limits. So if you have multiple credit cards and you close a bunch of them, then you just close down your total credit lines. So now, if you had $4,000, but you had 6 credit lines open and those totaled 15, you're okay. But let's say you had those same credit cards, you owed $4,000 on them, you closed a bunch of them, but then you close all your credit lines and now you only have a total credit line of like $8,000. Well, now you're at 50% of your limit. So just be careful on that. No one needs to have 68 credit cards open. I went to a talk once where someone from actually the FICO, where they kind of came up with the model, was speaking at a mortgage conference, and that's where I found out about the credit finance companies, that they really look at those, but also they looked at on your credit cards, really 1 to 3 is probably the ideal amount to have. Now, if you had 4, it's not, it's not going to be a huge drop, but ideally you had 1 to 3 and you had decent credit limits on those. I mean, even if you had 4, but maybe only used 2 of them, that was ideal. That's what they said. And excessive credit shopping. It can tell if you have gone out on a shopping spree and you spread it out over a bunch of cards. the bureaus can see that, and they think, and if there's no history of excessive shopping, they will drop you because they think that something is going on where you're going to need to use a bunch of credit and it might go bad. So I'm trying to think of some examples, but because if it's on one credit card and you usually have $200 on that each month, but it jumps to like $6,000, for 1 to 2 months, they're not going to think that's bad. But if you carry that balance month after month after month and you've never done that in the past, that could drop you a little bit. But really what it's looking at is if you have multiple credit cards and you have a history of just using 1 or 2 of them at a certain level, but all of a sudden you crank all of them up, that's excessive shopping. And you carry those over for a few months, something's going on.
This might be a dumb question, but does a debit card that can be run as a credit, that has nothing to do with this,
No,
right?
and thank you for asking that. Because with us, right, to get the 2.25% of your checking accounts, we make you use your debit card, but choose credit. The only reason that's out there has to do with the fee, the debit card interchange income. If every time you choose debit, the fee gets put on the financial institution. When you choose credit, it goes on to the store that you're using it at. So we will pay you back that 2% interest that you made on your checking account if you choose credit, because we're not getting a fee on that. That's a good question. So whenever you choose credit, it's not a credit card transaction. It's still like comes out as a debit card transaction. It's just how the fee is run. But you do not get credit for that. However, this is off topic, but we would have to battle people that wanted to use our checking accounts and get 2.25% interest. But what about those people that use their credit card for everything and not the debit card to get rewards? So we are actually coming out with like a rewards credit card for the people that do that, which is smart to actually get all the reward points, but then they would miss out on all the checking account perks because they weren't using their debit card 10 times a month to buy anything. Having more credit card debt in relation to your installment debt. So that would be like if you had more credit card debt, if it was excessive compared to your mortgage or your car loans, okay? And then finance companies again. How do you improve your score? Reduce the credit card balances. Do not close credit cards because your capacity will decrease. However, if you have 10 cards, close some of them, right? And just have a good mix out there. And the no-brainer one is make payments on time. The older the late payments are, they become less significant with time. So just that time heals. But the easiest one is if you have credit card balances, it's just to get those under the 30%. But also, if you just use one credit card, spread that out. If you carry a balance every month on it, open up another one and spread that out over 2 to 3 cards to bring that credit line, that proportion of the balances down. And then slow down on opening new accounts. Don't, every 6 months open up a bunch of new stuff. That hurts you as well. And really, this is kind of the last slide, but everybody in this is advice that everybody needs to hear. You're entitled to 1 free credit report every single year, and you need to do it because there sometimes can be collections that you don't even know about because they don't contact you or they don't know where to contact you at. I cannot tell you the number of times when I used to be a lender, I would pull a credit report and people were dumbfounded because there was a stupid collection from MediaCom on there from college when they moved out, and for some reason the equipment was in your name, or you moved and you didn't return something like the modem, and MediaCom slapped you with the collection. So it's a good idea to go out there, annualcreditreport.com, or if you go to Experian, Equifax, or TransUnion, you can go to their individual websites and get one from them as well. What I use and others, and probably everybody knows about them because of their obnoxious commercials, but Credit Karma is awesome. I have it as an app on my phone, and it'll send me notifications in my email. And you can set it up to get notifications on your iPhone or whatever phone you use. If for some reason an account is open, it'll tell you. It also, you can track your balances. So for some reason, your balance on one of your credit cards went up, you're like, that's weird, I've never used that card. Then you know something's going on. So Credit Karma, it's free. You know, how can they do it free? Well, sometimes they'll give you offers on credit cards. All you do is ignore it. They don't send you notifications. Just when you get into the app or the desktop version of Credit Karma, every once in a while, it'll just, some sort of advertisement will come up. You just get out of it, and you can see every single new account that you've opened, all of your old stuff. It shows your history, but it gives you a snapshot of your score. It is not, I would say it's within 30 points of probably what your real score is, but you can tell if for some reason your score is 620, you know, okay, I've got some work to do. But if you're over 700 on Credit Karma, you know things are in place. But to me, that's what I would do, is just download the free app on your phone, check it once a month. And on mine, I think it sends me an email monthly. Here's your update on your credit report or your credit score. So that one, I think, if you take anything out of it, do that. Okay. Any questions that people typed in, or I know it's credit, but if you can at least get 1 to 2 things out of that, it's at least beneficial. But then you can at least know what sometimes your clients go through, especially first-time home buyers. The one thing that they don't have is credit established sometimes, or they have a bunch of student loans out there that they maybe don't know about, and they got to get taken care of. All right, that's it. Appreciate it. Got done, and I try not to do like an hour of that.